One of the more unique business models developed over the past decade has been the business model that Opendoor is still using. Now remember, this is something that Zillow tried to copy, basically buying, selling, flipping homes, becoming a market maker for homes, if you will. The question is this a sustainable business model long term? And that's really what Opendoor investors are grappling with right now. Seems like there's some good news for the company periodically, then there's some bad news. And I think what we have to consider if you're looking at this stock is this a sustainable business model long term? Can they have predictable margins? Are they able to price accurately so that they know what that margin is going to be? Can they sell it fast enough? If you're only turning over each home that you buy every 3 or 4 months, that's going to take a lot of risk onto the balance sheet, because if something happens in the housing market, like interest rate changes, which have happened over the last couple of years, that can be a devastating impact on your balance sheet and destroy your business almost overnight. So with this backdrop, I wanted to look at the second quarter results and show exactly what we learned from Opendoor. Looks like there's a little bit of progress, but then you look at guidance for next quarter, and that kind of takes away a little bit of that optimism. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start a little ways down on the earnings release and look at their contribution profit and explain exactly what's going on here. So this has all of the historical numbers going back to the June 30th, 2023 quarter. That's why I wanted to start here. And you can see that revenue has picked up a little bit over the last 3 quarters, and margins, depending on what you're looking at, look pretty good, 8.5% from a gross margin perspective. Adjusted gross profit is 10.2%. That's consistently higher over the past year. So again, we're looking at some pretty good trends right now for Opendoor. Now what they do is, what they talk a lot about on their earnings release and their conference call is contribution profit. What that tries to do is say, how much money are we actually making on each one of these transactions? So what's the borrowing cost? What's the selling cost? So there are direct selling costs. And if you go down here, you can see what some of those direct costs are. Selling costs incurred related to the home in a relevant period primarily includes broker commission, external title, and escrow related fees and transfer taxes. So all those costs that go into buying or selling a home, if you've ever done that. Holding costs on sales. So this is going to be interest on the debt that Opendoor has to take out to hold a home. And they're adding both the current period right here and the prior period. So this is a pretty good proxy for how profitable the business is. You can see that this is improving quarter after quarter. So if we were on the path to contribution profit being $100 million and maybe growing at a double-digit rate every quarter, that would be great news. But here's the challenge. Management now expects third quarter 2024 revenue to be down to 1.2 to 1.3 billion and contribution profit to be $35 to $45 million. This is despite the fact that they had more inventory on the balance sheet at the end of the second quarter than they had at the end of the first quarter. So it seems like the economics of this latest cohort is not as good as the previous economics. And so this is that volatility that you see in Opendoor's business. This is why the company only has a market cap of $1.2 billion, despite the fact that it's generating more than that in quarterly revenue right now. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So is there anything that says that this is fundamentally a sustainable business? I don't think we're seeing that in the results right now, and partially because the trends that we've seen over the last 4 quarters are going to reverse a little bit in the third quarter. I don't see those margins also being high enough to be all that attractive, given the fact that you're taking out billions and billions of dollars worth of debt. If we just have simply one dislocation in the housing market, that could wipe out all the profits and basically wipe out your balance sheet in a moment's notice. That's the fundamental risk that Opendoor has. That's one of the reasons that Zillow got out of this market. And if you think about where we are in the housing market today, we're still not really in a normal housing market. So if you have a very nice home, an attractive home to sell, you can do that by listing it almost anywhere and get a really good price. You don't have to go to Opendoor. They end up being the company that ends up buying the most undesirable homes. And I think that's fundamentally the problem. If this was a more normal housing market, or if there was a more normal housing market anytime in the foreseeable future, this could be a much more appealing business model. Those margins could move up a little bit. Maybe it would be sustainable to see contribution margins in the 6% to 8% range. But I don't see that being the case today because those other homes are simply not going to hit Opendoor. They're not going to get access to the homes that are going to be able to be flipped really, really easily. They're going to take more work. You're going to take more duration risk for homes just sitting on the balance sheet for month after month after month. And you can see this volatility in the company's results. This chart shows Opendoor's revenue and net income from 2017 through today. And you can see that the company was an absolute growth machine through 2022. But look at losses as the company grew. Those losses got bigger as Opendoor grew. Now, net income doesn't necessarily account for all of the value that you're generating as a company because there are things like stock-based compensation, which can be relatively high for a company like this. So let's look at free cash flow. This is another way to judge how well a company is doing, how profitable the business is. And again, you can see that 2021 was just a terrible year. You do have a couple of positive years in 2022 and 2023. But then over the last 12 months, as the company has bought more homes and increased that inventory, your free cash flow starts to go down. So do we see a consistent trend here? And I think the answer is no. And this is fundamentally the problem for Opendoor is if you're not maintaining a consistent margin, if you're not showing that you can be profitable as a market maker in the housing business, then this is a very difficult business to invest in because those losses, those dislocations can be absolutely enormous and can be devastating for a company like Opendoor. Just look at how bad 2021 was. And I don't see this challenge changing anytime soon for Opendoor. This is why so many companies have left the market. So potentially an interesting entry point if this is a model that ends up being sustainable long-term, but I don't see the evidence in the financial results. And that's the reason I'm going to stay out of the stock for now. But I like the attempt at a new business model because I do think being basically a market maker, providing liquidity for sellers in the housing market should be a valuable position. This isn't going to be a kind of business that's going to buy 1 million homes a year. But if they can buy and sell a few thousand homes per quarter and do that profitably, they're adding value to everyone in the market. If you've ever sold a home, you know that it can take many months to get the money. The negotiations can be difficult. Showings can be difficult. Just being able to sell to Opendoor could be very valuable and worth potentially taking tens of thousands of dollars less depending on the home that you're selling. So I'm intrigued by the business model, but I don't see evidence in the numbers today that this is the kind of stock that I want to invest in. But we'll see how things go over the next few quarters. So subscribe here to Asymmetric Investing to see what I think about Opendoor in the future, what other opportunities I see in the market. Let me know what you think about the stock in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.